Hello everyone, I'm Romeo Razzi. I'm a CPA and I used to work at the IRS. Buy now, pay later has become credit cards, tax reform is stuck in the Senate, and what's going on with real estate. Those are the things that I'm going to cover today. Buy now, pay later has recently been reclassified as credit card providers by the Consumer Financial Protection Bureau, also known as the CFPB. For those of you who shop a lot online, which is almost everyone now, when you go to check out, a lot of times right by your shopping cart, you'll see a little section that pops up that'll say, hey, you can pay this over 3 or 4 easy installment payments, interest-free. And there's a bunch of companies doing this. The 3 big ones are Afterpay, which is owned by Square, Affirm, and Klarna. What the CFPB has decided is that these buy now, pay later companies are credit card providers. Now that they've become credit card providers, there's additional things that buy now, pay later companies have to do. The reason for this is because the Consumer Financial Protection Bureau decided that these buy now, pay later companies hadn't been doing things that were good for the consumers. And by reclassifying them as credit card providers, there are additional things that they now must do. Out of all the things that these buy now, pay later companies have to do, there are 3 that are really, really important. The first is they have to handle dispute resolution. The second is they have to deal with refunds from customers. And the third is that they have to be more transparent when it comes to their billing practices. I've never used these buy now, pay later things. I usually only buy things and I don't do the installment payments most of the time. I've never used Affirm or Klarna when it says 3 or 4 months interest free. But apparently customers were having difficult times with dispute resolution in their refunds regarding these buy now, pay later companies. Additionally, now that they have to give statements out, consumers are going to be able to look at the statements and see if there are any additional charges or what they're paying for. Because these buy now, pay later companies have been making most of their money by either the merchant processing fee, because when you go and purchase the item, there's 2 or 3% of merchant processing fees that go to Visa and MasterCard, and usually there's a small amount like basis points they get kicked back to the merchant processor. So these buy now, pay later companies were making money off that. They were making money off late fees. And if you ended up extending the terms of your payment more than the free 3 or 4 months that they offered, they would start charging you interest for that. So now there's more transparency among what's happening when you pay them and where your money's going and how much they're really charging you. Overall, I think this is good for consumers because they get to watch what's happening with their money. If they have any type of dispute or refund issue, just like with credit card companies, you call them and handle it. These buy now, pay later companies can't kick the can somewhere else or make it more difficult. They have to make it very transparent and easy for you to do dispute resolution and refunds. This is very bad for the buy now, pay later companies because now they're going to have to put in policies and procedures that are more bureaucratic, and it's going to affect their bottom line in order to adhere to all the new regulations they have to deal with now that they're credit card providers. The next item of news I wanted to talk to you guys about this week is tax reform. In case you're not aware, at the end of 2025, Trump's tax reform is going to expire, which means automatically, if Congress doesn't do anything, at the end of next year, taxes are going to go up. So Congress is starting to get a little itchy around things regarding tax reform. In January, the House of Representatives passed a bill entitled Tax Relief for American Family and Workers Act of 2024. This bill had a bunch of provisions in it, and I want to go over the most important ones with you today. The first thing that was proposed in the bill was something called the Child Tax Credit expansion. And what that would do is it would increase the size of the refundable credit in the child tax credit. For most people who aren't aware, tax credits are normally not refundable. What happens when you get a tax credit is if your taxes are less than the tax credit you get, most of the time tax credits get carried forward to the next tax year. So there's not really a use it or lose it with most tax credits. They just get carried forward. But in some particular cases, tax credits are refundable, like the earned income tax credit and a small portion of the child tax credit. Well, this bill that was passed by the House of Representatives wants to expand the amount of the refundable portion of the child tax credit. Now, the bill says that they want it done for 2023, 2024, and 2025. So if you've already filed your return and this bill goes into law, you will have to amend your tax return to get that refund. The second thing I wanted to talk about that's in the bill is 1099 thresholds. If you're an independent contractor or an entrepreneur, you usually get 1099s. And the threshold for you to get a 1099 is $600. In this bill, they are proposing to raise the threshold from $600 up to $1,000. Not only that, they're also proposing that the 1099 threshold limit also be indexed for inflation. Now, I think $1,000 is better than the $600 limit because $600 isn't what it used to be. But if you look at when the 1099 miscellaneous or 1099s for independent contractors originally came out, and you index from that point of $600 to today, really the threshold should be closer to like $2,600. But anything they can do to raise the threshold, I think is great. Because at some point, it becomes burdensome for businesses to issue these 1099s to so many people. And now that they're trying to go after Venmo and other avenues, it makes more sense for them to raise the threshold. The third thing in this bill that I wanted to let you guys know about is they are thinking of raising the limits for both the 179 deduction and bonus depreciation. 179 election and bonus depreciation are special parts of the IRS tax code that say if you have a certain asset, you have to put it on your balance sheet and depreciate it over many years. However, if it qualifies, you can use the 179 deduction in order to expense the entire asset instead of depreciating it over many years. And with bonus depreciation, it allows you to go ahead and expense it even though you put it on your balance sheet. With the 179 deduction, currently, the level that you can deduct by putting assets on your balance sheet are $1.16 million, and they want to raise it to close to $1.3 million. With bonus depreciation, currently, you can deduct 60% of the value of the asset in 2024. And what this bill wants to do is make it go back to what it was 2 years ago, which is 100% deduction. Now, the biggest difference between a 179 deduction and bonus depreciation is in order for you to take the 179 deduction, you have to be profitable. However, with bonus depreciation, you don't have to be profitable. There doesn't have to be a net profit in the business for you to expense that asset that you put on the balance sheet. The fourth thing that I want to talk about that's really important are changes to research and development expenses. Part of Trump's tax reform was that R&D expenses, research and development, could no longer be expensed. It had to be put on the balance sheet and it had to be depreciated over 5 years. And if the people or organizations you were paying to do the R&D were overseas, they were not domestic in the United States, you'd have to depreciate it, or amortize it is the correct phrase, over 15 years. And so what this has done is it's created a huge problem for companies that are heavy in R&D, especially companies in the startup space. Because companies in the VC and startup space usually they get a couple $1,000,000 from investors, and they take a really large portion of that money and use it for R&D. And what ends up happening is the first year that you amortize these R&D expenses, you have to use a mid-year convention, which means it doesn't matter if the expense was in January or in November. You have to say all the expenses happened on July 1st, right in the middle of the year. So it really takes like 6 years to deduct all those expenses, because you get a half year the first year, then you get 4 more full years, and then a half year on the 6th year. And what this does is if your startup isn't really bringing in a lot of revenue yet, well, you spent all this money on R&D, but because it's on the balance sheet and you're only amortizing a small portion of it, it takes your company and makes it profitable for tax reasons. Even though you might have spent millions of dollars on R&D, you're now stuck with this giant tax bill. It's been a huge problem. This is something that's been on the chopping block for a while. Startup founders and a lot of companies have been complaining about this from Trump's tax reform. I have a belief that even if the Senate doesn't pass this bill, there is going to be a big change for this R&D. And the proposition in this bill is to go back and retroactively change it back to 2022. So if this does get changed and does become a bill, or it does become law, startups and companies that used to amortize their R&D will have to go back and amend their tax returns so they could expense it all. And the last thing I wanted to tell you that's in this tax reform bill is that the IRS is asking if Congress can extend the statute of limitations on audits for ERC tax credits. For those who aren't aware, ERC is Employee Retention Credit. It was a big program that was available during COVID. Same with like PPP loans, EIDL loans. There are all sorts of programs. These ERC tax credits, there seems to have been an unbelievable amount of fraud regarding these credits. Because the thing with tax returns are, CPAs and tax return preparers are not allowed to go to you and say, hey, if I get you a bigger refund, pay me more money. You're not allowed as a tax return preparer to say, give me a percentage of what I bring you. But there are 2 places that you can do that. One of them is IRS remediation, which is if you have like $500,000 in penalties to the IRS, and a CPA can come to you and say, hey, if I get rid of it, give me 10% or 20% of whatever I get rid of. The second place where CPAs and tax preparers can get a percentage is tax credits. So you can't do it with regular refunds, but you can do it with tax credits. So all these firms and law firms and shops and organizations quickly sprouted up all over the country telling people that they may qualify for the ERC. And what they would do is they would apply for your ERC and they would make an agreement that you would have to give them 30% of whatever they got, or whatever you got back in a refund. And so what's happened is this has been rampant for fraud to the point where the IRS cannot keep auditing them, and they can't even keep processing them because so many of them are still coming in. So the IRS has asked Congress to extend the statute of limitations on this, and it's also asked to make any firms or groups that have been promoters of putting together fraudulent ERC tax credits, that they will personally be on the hook for any penalties or taxes that are due. Now, regarding this bill that the House passed, it has still not been taken up by the Senate yet. And right now, it's not certain whether or not the Senate will or won't take it up. And the reason for that, there's a little bit of pushback because at the end of 2025, as I mentioned earlier, Trump's tax reform is over. And so there are some members in Congress that are saying, hey, let's not touch this. Let's wait until after the election, and then we'll have more bargaining power, or it's a better time to do a complete overhaul of taxes. So as always, if this thing moves to the Senate or it gets killed in Congress, I will definitely let you guys know. Now, the last thing I wanted to talk to you guys about this week is what's going on in real estate. I'm sure everyone is talking about real estate and interest rates. As you're aware, or maybe you're not aware, the Fed last week decided they're not lowering interest rates. And last week, the CEO of Redfin had gone on interviews with both Fox Business and CNBC Squawk Box to talk about what he believes is going on with real estate in the country. There are a few things that the CEO of Redfin had mentioned during his interviews. One of the things he mentioned is right now he's seeing, because of the interest rates, a lot of homes that are in contract are falling out of contract. He said, according to his Redfin data, that around 20 to 25% of all real estate transactions that were in contract failed or didn't go through. And I'm an avid investor in real estate. I've been in real estate for 20 years. And I have noticed on websites like Redfin and Zillow and even Realtor.com, properties that have been set for sale, they'll go into pending status or contingent status, which means they're waiting for it to close. Just 4 months later, boom, it's back on the market. And the description will usually say something like, back on the market, this home, your dream, it's here. So a lot of these properties have been falling out of escrow or not closing. And the Redfin CEO believes it has to do with the high interest rate levels. The other thing he said is that millennials are feeling like they will never ever be able to buy a house, and that the idea of the American dream to them will never happen. As most people are aware, one of the staples of the American dream is owning your own home. And because of the cost of real estate right now, and the interest rates, and the lack of inventory, it's very hard for people to buy homes. And so one of the things that you should be aware of is that real estate is currently in a recession. Real estate recessions aren't like normal recessions because the real estate might still actually be moving up a little bit in value, but there's still a recession because there's no activity or not a lot of activity compared to what's normal. And normal activity in the real estate market is having around 1 to 1.2 million homes listed for sale. And currently, there's about 600,000 homes available for sale. So anytime you log into Redfin or Zillow or Realtor.com to look at a map with all those homes on there, think to yourself that the market is would be normal if the number of houses on your screen when you're looking at all those homes was doubled. And because there's such low inventory, there's this shortage and it's causing a recession. And the reason for that shortage of inventory is because people who refinanced their homes or bought homes 3 or 4 years ago got them at such low interest rates that they are not interested in selling the home to go move to another house with a higher interest rate. One of the things that you need to think about when it comes to home sales are sellers are also buyers. And what that means is that usually a family that wants to buy a new home is also selling their home, or a family that's selling their home wants to buy a new home. And so ultimately what happens is maybe their family gets bigger, they realize, oh, I like this house, but I don't love this house, so I kind of want to have a different house, maybe closer to work, or whatever the reason is. And so normally those people would go buy a house or sell their current house and then go buy a new house. But because of the large disparity in interest rates, a person is not going to go from a 3.5% home to an 8% home just because they want an extra 300 or 400 square feet and they want an extra bedroom. So that's forcing a lot of people to sit on their properties and not sell them. The other thing that the CEO of Redfin had mentioned is that across the board he has seen around 6% of the price of homes drop in the last year across the country. Now it's very different in different areas of the country. Obviously, the price differential of dropping between New York or Vegas or Miami are going to be wildly different. But according to his Redfin data, he said across the country, home prices have dropped roughly 6%. And the other thing he had mentioned is that he said that if you are able to buy a home, you may want to think about buying one now. Now, I understand that he's the CEO of Redfin, and it's his job to push the idea of purchasing homes. But the argument he was making was that when interest rates come down, because we all know interest rates can't stay here forever. They're going to have to come down. They've come down in Europe. They've come down in Canada. They're going to come down here eventually. His argument is that when interest rates come down, a bunch of people are going to take money that is, and he didn't say this directly, but I'm reading between the lines of what he's saying indirectly, is that when the interest rates come down, people who have a bunch of money sitting on the sidelines are going to take that money and shove it into real estate. And that's going to drive the cost of the real estate up. And the reason they would do that is right now, if you have a bunch of money, like you're a really good saver, you save your money like a squirrel saves nuts, and you have a pile of cash, chances are, if you're smart with your money, it is sitting in a money market account. And this doesn't mean it's in stocks, but it's sitting in a money market account or it's in a CD because you're waiting for an opportunity to do something with that money. And while this pile of money is sitting in a money market account or a CD, it is currently earning around 4.5% to 5% of income, interest income. And when interest rates come down by the Fed, what's going to end up happening is that money market account is no longer going to be giving 4.5% or 5%. It's going to start giving 2%, 2.5%. So what the Redfin CEO is saying indirectly is that those people that have that money are going to want to take the money out of these money market accounts, and they're going to want to look for opportunities where they could shelter that money. And one of the places he believes, and I also believe they're going to take that money, is into real estate. Because if you're going to get 2% return on a money market account or CD, or a 2% return in real estate, you may rather want to put it in real estate even though it's a bigger hassle, because at least in the real estate, you're going to have a bigger hedge against future inflation. So, with that being said, currently, I think if you can buy a home, you may want to highly consider it. One of the things I look for when I'm investing is to make sure it cash flows and it has a good ROI on that cash flow. As long as it could match what's going on in CDs or money market accounts, that's where you want to go. You probably won't find those deals in residential real estate right now. However, you may want to consider moving some of that money into real estate anyway, just because when interest rates drop, there may very well be a glut of investors and people sitting with money in money market accounts that'll just take their money from their money market accounts and shove it into real estate and push up the cost of that real estate again. I hope you really enjoyed all the news and financial insights going on for the week. You can follow my socials down below. And if there are any other topics you want me to cover, please let me know in the comments. Thanks.